This is your LMAX exchange technical update for Monday, July 3rd, 2017. Euro dollar. So the euro has extended its run of 2017 highs with the market pushing up most recently above 114, but it's critical to know that the market is now also coming into some major resistance in the 115 to 117 area. If we pull back the chart to the weekly, you can see that the market has been basically in a consolidation over the past several months and few years since bottoming out in 2015. The market has been trading in this consolidation, and so topside failures have been seen in 2015 at 117, another lower topside failure in 2016 in the 116s, and so this latest rally could once again find some significant resistance up towards the 115 to 117 area. If we draw a falling trend line off of the highs that we had seen in 2015, that trend line resistance coincides with the 115 area, and remember, the breakout that we saw the other week above 113 followed a consolidation between 113 and 111. That's 200 points, projecting a move up towards 115. So if the market does get up to the 115 area over the coming sessions, expect the market to start to find some significant resistance, and the possibility then emerges for some form of a major top and the market rolling back over for a bearish resumption. A break back below 111.10 would be required. That's the most recent higher low, would be required to officially put the pressure back on the downside. But again, the key takeaway right now is that although we've seen a serious uptrend in 2017, when you pull back the chart, this is a market that's showing nothing more than what could be a consolidation, a bearish consolidation within a longer term downtrend in euro dollar. Sterling dollar. So cable is traded all the way back up in recent trade to look to retest that 2017 high at 130.48. The market could establish above that level over the coming sessions, and ultimately here on a medium to longer term basis, the focus now is shifted to the top side following a breakout in April above a previous range high that had capped gains for so many months since basing out at 118.40 in October of 2016. The market had based out and then was consolidating with that 127.75 area, capping any rallies, but the breakout above 127.75 in April of 2017 suggests that the market is putting in this longer term base now and is ready for a more meaningful recovery. And again, that next key upside extension comes in at 135 following that consolidation, roughly for the most part between 120 and 127.75. At the same time, on a short-term basis, while we have seen this impressive gains over the past few sessions, and the market could look to poke above that previous 2017 high at 130.48, there is risk for a short-term reversal, and we could still see some more choppy consolidation around the 130 area, roughly between the 126 to 130 area, before the market eventually heads up towards 135. So don't rule out that possibility. A breakdown back below the Friday low, which comes in around 129.45, would suggest that the market is looking to top out and roll over again in the short term. But ultimately here, the market should now be very well supported into dips, with the expectation that we see an eventual push up towards 135 and above. Only back below 123.60 would compromise this constructive outlook for cable. Dollar yen. So dollar yen has put in an impressive rally over the past several sessions, trading up just shy of 113. But here it's important to note the longer term trend, which still favors the downside over the past few months. And so there is risk for this topside failure to lead to another downside extension back towards a retest of the 2017 low just shy of 108. It would take a break back above 114.37, the high going back to May, early May, to take the immediate pressure off the downside in dollar yen. Euro Swiss. So Euro Swiss has been chopping around roughly in the 108 to just shy of 110 area over the past several days, but the market has been unable to establish above this psychological barrier at 110, which is actually also a meaningful level in terms of defining this market on a medium term to longer term basis. If the market can establish above 110, it will officially shift the structure to the top side and open the door for gains over the coming months. If, however, the market is unable to establish above 110 and fails ahead of 110, again, it keeps the overall pressure on the downside and suggests we could see a resumption of declines back down towards more meaningful support just ahead of 106. Of course, it would take a break back below recent support around 108.30 to strengthen that outlook and accelerate declines. Aussie dollar. So Aussie has come up over the past several days and is now closing in on a retest of the 2017 high at 77.50. Having said that, this is a market on a medium to longer term basis that has been very well capped into rallies up towards 78. And so the expectation, especially following this latest surge, is that the market could very well stall out again up towards and ahead of 78 in favor of a resumption of declines back down towards those recent multi-day lows from May, which come in around 73.30. Dollar CAD. So dollar CAD has seen a collapse over the past several days since putting in a 2017 high back in May, which comes in at just shy of 138 at 137.94. The market has since collapsed down below a major psychological barrier at 130. But overall, this is a market on a longer term basis that has been in a recovery and is in a broader uptrend. And so this latest pullback below 130 is expected to be very well supported, especially with the market now trading into oversold territory on the daily chart. Of course, a break and close back above 130 would be required to take the immediate pressure off the downside and suggest that this market is finally looking to base out after this pullback that we've seen over the past several weeks. Really, at this point, only the establishment, a clear establishment below 130, maybe on a weekly basis, would force a reconsideration of this more longer-term constructive outlook in dollar CAD. Kiwi dollar. So the New Zealand dollar has put in a very impressive recovery since basing out by 2017 lows in May in the 68.20 area, with the market now looking to retest and potentially want to break above the 2017 high, which comes in at 73.76 from all the way back in the month of February. But overall here, this is a market that is also showing on a longer term basis being very well capped into rallies up towards the 74 to 75 area. And so expect the market to once again stall out here in favor of a bearish resumption back down towards those 2017 lows around 68.20. SPX 500. The S&P 500 has been trading within a very strong uptrend over the past several years, making record highs, and the market has continued to focus on that fresh record high run with the next key extension objective at 2480 following a period of consolidation that was seen earlier this year between 2400 and 2320, an 80-point consolidation, therefore projecting 80 points above 2400 to 2480. At the same time, the market has been showing a little bit of an exhaustion over the past several sessions, but it would take a breakdown back below 2400 at a minimum to take the immediate pressure off the top side, while a breakdown below 2320 would be required to force a meaningful bearish shift in the structure. Gold. So gold has been overall trading it within a constructive outlook over the past several months, uptrend with the market putting in higher lows and higher highs since basing out in 2016. And so this latest setback from 2017 highs that were established in June at 1296 is viewed as corrective, with the market expected to now put in a higher low somewhere above the previous higher low around 1214 ahead of the next major upside extension and bullish continuation beyond 1300 and towards a retest of the 2016 peak at 1375 further up. Only back below 1214 would compromise this constructive outlook for gold.